Good morning. It's the 3rd of August, and this is Stocks and Unders weekly investor webinar. It's August, as I said, and that means that earnings season is upon us. So that should be very interesting, because I think the market turbulence in just the last few months, that confirmation of sort of negative sentiment would only come from company earnings, and we'll see how that plays out in the next couple of weeks. But before then, today we've got a few very interesting topics, I think, Stuart. We've got a presentation on fertilizer plays on the ASX, because fertilizer is interesting in itself, especially with Ukraine and Russia going at it. So there's a lot happening in that space. We'll have a quick look at Breville that we wrote about on Monday, and we'll also take a look at Cobalt. But Stuart, let's kick it off with the fertilizer stocks.
Yeah, so now is a good time to be looking at companies involved in fertilizer. And there are a number of reasons for that. We often get questions, tell me the difference between potash and urea, for example. Well, we'll cover this off in future webinars, but let's just do a basic run over of some of the issues involved in companies that are developing fertilizers. First thing to understand about fertilizers is it's a growth industry, and no surprises there. The world population continues to grow. By about 2050, it's believed that we'll have close to 10 billion people on the planet. And those people en masse will be more middle class than they are now. And when you get into the middle class, you tend to eat a little bit better. So more people eating more food means greater demands for fertilizers, so that we can supply those needs. So talk to any expert in the fertilizer field, and they're expecting demand for their products to rise in the order of 3% per annum, pretty relentlessly for the next couple of decades. It's not quite a ground floor opportunity, but it is close to it. What's made fertilizers even more newsworthy is what's happened in 2022. Traditionally, the former Soviet Union was a big producer of fertilizers. Remember, Russia itself stretches over 6 time zones and has a heck of a lot of fertile land. And so the fruits of that is Russia and Belarus were major producers of fertilizer. Well, they're now suddenly offline to their export markets as a result of the sanctions that started with the war in Ukraine. No surprises then that the global price of fertilizers has jumped markedly. The chart there on the right of that slide is DAP, diammonium phosphate, priced in Australian dollar terms. Not long ago, you could get DAP for about $600 a ton. It's now about double that. And that's one reason why, if you've been to the supermarket just lately, food tends to be a bit more expensive. So 3 key ingredients you need to be able to grow things. First is nitrogen, the second is phosphorus, and potassium, letter K, because potassium's Latin name is Callium. Since the game of fertilizers became a science, basically fertilizer companies experiment with mixtures of all 3 of those in any fertilizer that you for instance, would buy if you went down to Bunnings and bought a bag this afternoon. And that's what our ASX listed companies involved in fertilizers are basically looking for, is forms of that. So most of the companies on ASX are working on either P, that's potassium, or K, which is, K is potassium, P is phosphorus. And I'll talk about a few later in the game. With potassium, the big one obviously is BHP with their Jansen potash project in the Canadian province of Saskatchewan. There's also Callium Lakes, Danakali. For the phosphorus plays, companies involved in phosphate rocks, Centrix and Fosco. So there's a fair few companies involved in the space, and they've been waiting for a time like 2022 to really rev up the development profile for those companies. Potash. Potash is simply potassium carbonate and potassium salt. Traditionally, Russia and Belarus were big suppliers. Canada was also a big player as well. Russia and Belarus are offline. Now's the big opportunity for the Canadian players, and BHP wants to be a player there. When you hear companies talking about potash, they talk about 2 different products. One's called sulfate of potash, SOP, and the other's called muriate of potash. Sulfate of potash is just K2SO4, combination of potassium and sulfur. MOP is potassium chloride. The reason why they're all talking about sulfate of potash, or SOP, is that's the one you need for crops that are sensitive to chloride, such as fruit and vegetables, etc., which is obviously a higher margin crops than where the majority of potash goes, which is in the muriate of potash. So when you see the words SOP, that's an indication that the company's going after a potash opportunity. Key potash players, BHP basically sold their oil and gas division recently to Woodside, and they argued that they would make more money in potash out of one project called Jansen, which is up in the northern part of Saskatchewan. It's so big it probably won't start producing until around 2027, but it will take advantage of this outside demand for potash at a time when the Russians are off the game. A little company called Callium Lakes in Western Australia just got started on its Biondi project. We wrote about that last year. More recently, in March of this year, we wrote about Australian Potash, which has a project called Lake Wells. And way over in Eritrea, Danakali, which we wrote about as we were starting Stocks Down Under 2 years ago, is developing a project called Kaluli. So a number of significant players. And Callium Lakes, which I'll talk about a little later, is worth watching right now. There's the chart for Callium Lakes. As you see, it's been all one way since the middle of last year. What's gone wrong for Callium Lakes? Well, you pump up the brine where the potash is held. They've discovered that they've had problems getting those brine production rates to work as expected. So the company's had to admit from earlier this year that it'll probably produce about 80,000 tonnes a year of SOP rather than 120,000. Market doesn't like that. The company will also need some project financing in addition to what it thought it would raise in order to realise the value of Biondi. But what's significant to me is the first commercial sales of SOP from out of Biondi just got completed last month. So basically, it's a company that's arrived now as the first SOP play in Australia, selling into a pretty good market with good pricing, but needs to fix its production issues. So it's a classic case of one of those companies that's run into some teething issues in its production process. We're watching that one very closely because the stock's got a very strong support level, about 6 cents a share. Obviously, they're going to need to raise some more project financing for that company. But if that becomes available, we have a sneaking suspicion that Callium Lakes shareholders from this point are going to make out quite well. Let's talk about phosphates now. Phosphates are the other big fertilizer opportunity on ASX. The phosphate market is dominated by Morocco. Morocco's got about 70% of the world's reserves of rock that's dug out of the ground, processed, and then shipped around the world. You take the phosphate rock and you convert it into MAP, monoammonium phosphate, or DAP, which we talked about earlier, diammonium phosphate. But there's not enough of the original rock going around. So I've actually seen serious discussions about peak phosphorus. That's a great opportunity for new companies with sources of phosphate rock that they can go after. And we've identified 2 of those on ASX. First of those is Centrix, which we wrote about back in June, on the 9th of June in Stocks Down Under. They've got a project in northwestern Queensland called Ardmore. Second one, a little earlier in the game, Fosco. They're trying to develop a large phosphate rock project in northern Tunisia. We wrote about them also in June. But there are other players which are listed on the screen there. We know a little bit about Agia Resources, which has some deposits in southern Brazil. And there's also Minbos. So Fosco illustrates the opportunity here. There's Tunisia, which if you look at the map, it's right at the top of Africa. So a big opportunity to sell phosphates into Europe should they ever develop their mine there. They've got a 30-year mine life. Relatively easy to process the phosphate rock into the sort of 30% P2O5 product that the European customers would take. And they're now going after a court action in Tunisia to get hold of 100% of their project. They've got 50% of it at the moment. So if you look at that one, the market's pricing the opportunity for that one is next to nothing because it's very early stage. The one that we're interested in right now that has actually got potential this year is Centrix, which we look at in the next slide. There's a map of northwestern Queensland, Mount Isa there, and it shows you that it ain't too far from Ardmore to the port of Townsville to ship out the phosphate rock, which this company believes it can develop at Ardmore. Centrix is pretty advanced. They recently snagged Robert Menzel as their new CEO. Robert used to run Ronphos, which is the phosphate company that mines the phosphate riches of the Republic of Nauru. He's left that opportunity to come back to Australia, and this is his next gig, basically. The company's done a definitive feasibility study on an 800,000 tonne a year operation. Pilot plant that can produce only around 250,000 tonnes started up recently, and it's actually producing better than expected. So the company believes it can replace the whole of the phosphate rock market in Australia, currently imported mainly from Morocco. with output of this plant, and they're selling as we speak. It's early days, but this one has potential to mature quite nicely, given that a relatively low injection of capital can increase the efficiency of the pilot plant they're working on now, and you get the full scale project on which they've done the DFS later on.
All right, well, there you have it.
So that's fertilizers in a nutshell. We'll probably cover up on this a little later. Fertilizers are a multi-year thing. I think it's fair to say, Mark, you and I aren't geopolitical experts, but the war in Ukraine doesn't look like it's ending anytime soon.
No, I suspect it will go on for a year at least. Yeah.
Right, and that means with lack of Russian product, that the world's fertilizer markets will be dealing with shortfalls for a while yet. In that environment, very much worthwhile paying attention to a lot of companies in this space.
All right. Well, as Monty Python once said, and now for something completely different. Breville, the coffee maker, or I should say the kitchen appliances maker. We wrote about them on Monday. And we wrote about it because we have been negative on Breville for a long time. So this is what Breville is. So coffee makers, all sorts of equipment, ovens, but they all look pretty good. Design type, it appears like it's designer stuff.
Now, Mark, I've been to your home, and you've got one of those fancy Breville coffee makers in your kitchen. It's fair to say you're a satisfied customer, right?
Yeah, definitely. The one on the left there, that's the one I have. And look, it's not cheap. This one was about, as coffee makers go, by the way, this isn't expensive because you've got the really high end stuff like Jura, which could be $4,000, right? So this one was actually doable, sort of 700-ish. But it's pretty good. It's really efficient. It's all integrated. So I'm a big fan of this one. But so who's Breville? Well, it's kitchen appliances, but sort of upper market, not the cheap stuff, not the most expensive stuff either. It's sold in North America, Europe, Australia, with North America being more than 50% of revenues. And if you look at the operating results over the last 7 years, the average growth rate there was close to 15%, which is pretty good, if you ask me. And I think that's also why investors for a long time have been willing to pay a very big premium for this company. And if you look at the first half of the past financial year, so July through December last year, sales were up 24% to 879 million. So a growth company within a not so growth sector actually. So discretionary consumer, it's very susceptible to fluctuations, to economic sentiment, that sort of thing. So, but it's done pretty well. So why have we been bearish on this one? Well, the first time we wrote about it was back in February 2020, a long time ago. Share price was $22 at that time, and we wrote about it last August. Share price was $33. Both times we put 2 stars on it, and mainly because it's just too expensive. If you looked at the valuation multiples, it's just too high. So 2 stars. EBITDA back then in the financial year 20 was 139 million. And if you look at where we are now, share price is sort of back where it was back then, so $21. But EBITDA for the current financial year, so the FY23, is expected to be over 200 million. So it's a big difference there, which has brought down the valuation, EV/EBITDA valuation, to roughly 14 times. And that comes down in the next financial year as well as EBITDA keeps on growing. So EBITDA growth for the current financial year, 12%. And so if you combine all that and look at the chart there on the left, you can see that the stock has been sold off quite a bit, from well above $30 to around 21 now. The dip actually was around 16, so it's bounced back a little bit. But on the current share price, we think the valuation is really interesting because you've got a sort of premium player that is growing fast. It's doing acquisitions. It just bought something in Italy, and so they're expanding globally, and the product just looks good, and people are willing to pay the good money for it. So you've got a premium player in our view. So on Monday, we put 4 stars on it. The results are out on the 23rd of August. So depending on your risk appetite, you might want to wait for the results in August, because it's in this market, it's tricky what the company is going to say, especially in the outlook with recessions looming globally. So you might want to wait for August 23rd to see what the company is going to say. But just now at current valuations, we think it's pretty interesting, Stuart.
Yeah, so it seems to me the opportunity here is to buy one of the best consumer brands available on ASX for the next phase of its growth, at a time when the market started to disbelieve in the power of that brand.
Yeah. So really the key is the US, right? So 50%, more than 50% comes from North America in terms of revenues. If the US actually goes into not a technical recession, but actually a big slump, yeah, Breville will notice that as well, right? So we need to see what they say on the 23rd, because that will be a big factor in deciding whether or not to buy this stock.
Right.
All right, and then final one, Stuart, Cobalt.
Yeah, so we've had a few questions about what to make of element number 27, Cobalt. And so I've titled this presentation, Cobalt Sings the Blues. Cobalt, as you know, has a bluish tinge to it when you see it. So often you'll see cobalt and blue used in a sentence. So there's a particular dye out there called cobalt blue. Cobalt's an interesting metal, traditionally used in alloys to impart strength, corrosion and wear resistance, and high temperature strength as well. Shows up a lot in magnets, shows up as a catalyst in the petroleum and chemical industries, used as a drying agent. But what we've been hearing a lot about cobalt in the last few years is its use in lithium-ion batteries, and that's not insignificant. Each of those batteries that goes into the electric vehicle you're driving around in right now could have about 15 kilograms of cobalt in it, depending on the battery chemistry that the makers have used. So that's an important reason to know about cobalt, because the electric vehicle revolution, as it gains ahead of steel, is going to consume a lot of this metal from wherever the battery makers can get it from. And that's why you can see this big spike on the chart here. Cobalt today is like nickel in the 1960s. Back in the 1960s, nickel was a relatively new metal, not new in the sense that it was new to chemistry, so much it was new to industry. There were a whole lot of new uses for it, but there were certain places that it was mined for, and suddenly the world found it was running short of nickel. That's what caused the Poseidon boom back in 1969 in Australia, is sudden shortages or perceived shortages of nickel. Well, I think the same is true of cobalt today. You can see a big run up from 2016 through about 2018. That was the first indication that that cobalt demand was running way ahead of supply because of the electric vehicle revolution. Now, users of the metal have a way of stockpiling what they need, and so sometimes these spikes turn out to be short-lived. And between 2018 and into 2019, a lot of that spike was given up. But look what's happened since then. You've had a second spike on top of that. Now, people are wondering what to do with this most recent run-up on LME that took it up to about $80,000 a tonne. It's now back at $50,000 a tonne. Is it going to give up all that ground yet? Well, it may or it may not. But basically, if you get involved in nickel, expect the price of the metal to jump around a lot. But it doesn't mean that the future of the commodity isn't bright. And if you pick the right project to invest in, you could make out reasonably well. Why does the world need new sources of cobalt? It's called the Democratic Republic of the Congo, that gigantic Central African country that the Belgians used to run up until 1960. So traditionally, most of the words cobalt came out of the southern part of what was used to be called Zaire, in the dark red column on the picture on the right, in Katanga, the Katanga region and neighboring provinces. DRC still accounts for about 2/3 of the world's cobalt production today. That didn't matter so much when cobalt was relatively insignificant. When I say relatively insignificant, it would show up a lot in industry, but it's not something that people needed to worry about where supply was. These days, users, particularly the EV makers, care a lot more about where their product is coming from, and they prefer it to come from a jurisdiction that is not the DRC. I like to joke that Coolio sung Gangster's Paradise. He was actually thinking about the Democratic Republic of Congo. So the race is on to find alternative sources from that country, basically. So there's two ways this can go. Either the battery makers start using less cobalt, and it is technically feasible to produce a lithium-ion battery without cobalt, or you keep the cobalt in and then find new uses for it. Turns out nickel alone would actually be a longer range battery, but it's unstable. You need the cobalt to keep the nickel in a lithium-ion battery stable. So it would be better. Now, I'm no expert, and Elon Musk has probably looked into this more than I have, but it would be better to find dependable sources of cobalt at a reasonable cost. And when Elon calls, I can get him a few ASX listed companies that would fit the bill. For investors like Elon and our viewers today, I'm arguing that it's best to wait until the commodity is really out of favor, like it was in 2020, like if it gives up a lot of the gains we've been seeing since 2020 in the current round. is the best times to buy cobalt stocks, because cobalt will be with us for a while yet. One to watch, which we wrote about last month in Stocks Down Under, is Cobalt Blue. We've got 4 stars on this one. They're developing the Broken Hill Cobalt project in Western New South Wales. Very important project. Been known about for a long time, but it's just getting ahead of steam under the current management team at Cobalt Blue. It's got major project status from the Australian government, which means it can move ahead faster. They've done a preliminary feasibility study back in 2018, and on a 17-year mine life, this thing is worth probably $800 million or so, which is way more than the current share price if you use the 7.5% discount rate. Obviously, discount rates are jumping around all the time, but at that time, the developers have suggested an all-in sustaining cost of $12 a pound, which is way below where cobalt is trading at the moment. So this thing has legs from a cost perspective, no matter what cobalt is trading at. And when cobalt goes for the kind of tier it's gone for up until recently, companies like this can come into their own.
Right. What do you know? What the current price is per pound?
I'd need to do the numbers. I usually think of it in tons, but take $30,000 a ton and divide it by 2,204. So that's roughly about $16 a pound, if my mental arithmetic hasn't failed me.
Right. Okay. All right. And yeah, look, the trend is your friend, right? And the trend in the price is down now for cobalt. So like you said, probably good to just see how that plays out in the near term.
Right. But so basically, watch the metal carefully. It's traded on. It's one of 6 metals traded on the LME. In fact, it's the most recent LME contract that was introduced a while ago. And when you start hearing investors moaning about how bad cobalt is, that's the time to take a look, because my money is on cobalt turning around from its lows reasonably swiftly, given the underlying demand from the EV makers as well as its regular industrial users.
All right, good stuff. Well, that's it for this week. We went a bit long, but for good reason, because as anyone can tell now, when Stuart talked about fertilizers, he knows his shit. So that's good. We'll catch up with you next week. And in the meantime, happy investing.
Stay bullish.